Okay, greetings. Welcome to this sponsored session. On behalf of Chemical Market Analytics, we're glad you're here and look forward to sharing with you a market briefing today. We're going to talk about it in terms of conquering market turbulence. And let me just, for those of you who may not know us, I think many of you do, we're a part of the Dow Jones family. Chemical Market Analytics, also Opus, McCloskey or coal markets, coal metals and mining, as well as PC Wire and other parts of Opus. And we also join our sister brands, Wall Street Journal, Barron's, and Factiva. So it's a pleasure to be with you today. We have a history of over 40 years, founded in 1979 as CMAI. We focus on not only where's the market today and why is it behaving the way it is today, but what is the outlook in the future and the core underlying drivers that are driving that market behavior. And we just finished our World Chemical Forum, our inaugural event. We had nearly 700 attendees where we covered not only the disruptive factors, but really the critical piece was not only the concepts, but what is driving the behavior. In a detailed way, supported by data and by deep insight. And this is supported by a team of over 200 consultants around the world, immersed in the market with commercial experience like many of you have as well. Our next year World Chemical Forum is already scheduled. It will be September the 9th through the 11th, 2024 in Houston, Texas at the Marriott Marquis. We really look forward to seeing you there. Once again, we'll cover not only the disruptive issues with supporting data and insight, but also the fundamentals of why is the market behaving the way it is today, where are we in the cycle, how do we emerge from it, what does it look like on the other side. With that, I now turn it over to my team. And again, we're going to take you through the various major value streams, value chains of the chemical industry. And I'll turn it over to Carlo.
Thanks, Dewey. All right, so I'm going to talk to you guys about, if I can get this to work, I'm going to talk to you guys about energy and energy transition, focusing a lot on the long term because I think it's really important and it informs what the market will do in the short term. But let's set the stage. What happened last year? The energy crisis in Europe. And talking to our European colleagues, many felt like this was akin to the energy crisis that was seen in the 1970s. Although in the US we didn't feel it, but the Europeans felt it very acutely. And so when we look at gas supply into Europe the year before, it goes without saying that the turmoil that was brought upon by the Russia-Ukraine crisis actually created this energy situation in Europe. So what did the Europeans do? They imported a tremendous amount of LNG, more so than they ever have in the past. That created a lot of affordability issues, especially when we're looking at the Asian markets. But nevertheless, when we focus on Europe, they also did a number of demand moderation policies, and there was a lot of demand destruction. And so really, when we look at what happened last year with the Europeans building the storage that they did and having a mild winter, they're actually set up very well for this upcoming season. So now, pivoting to that, when we look at the energy transition, we take a hard look at the degree increase out to 2100. There's three scenarios, courtesy of our friends over at Rystad Energy. And these three scenarios are a 2.2 degree case, 1.9 degree case, and 1.6. And when we look at how it affects gas, you'll see in a future slide how the effects on oil, but gas actually remains a little bit stickier than oil, simply because it's widely viewed as a transition fuel. The other piece too is that when you look at LNG, long-term contracting enables this fuel to stick around a little longer. And so when we look at the 2.2 degree case, that's really a business as usual situation. Slow adoption of renewables. Gas is used as a base load to to supplement the intermittency of renewables. But the 1.9 degree case is rather interesting because that's the Rystad Energy house view. It's consequently what we do our analysis on to provide a differentiated view in the market. So gas is used to continue to be used in the 1.9 degree case, also to balance renewables. But once we get out into the medium term and into the long term, certainly there is robust demand from industry as well as buildings. And then we do see some moderate development of hydrogen, especially as it relates to carbon capture and producing hydrogen in a green way. By the time we get to the 1.6 degree case, it is a super green scenario. High penetration of renewables. And really, when we look at all three of these cases, we look at the 2.2 and the 1.9 as the most realistic scenarios, and we actually view the range in between as what will likely happen over the next 30 years. So pivoting over to oil, which is a rather interesting case study in all these scenarios. When we look at the business as usual case, really you see that slow penetration of renewables, you see a slow adoption of electric vehicles, and as it relates to petrochemicals, there's some minor dislocations in supply and pricing, and there's also a modest reconfiguration of the refining complex to be able to promote additional petrochemical production. By the time we get to the 1.9 degree scenario, very much, almost 40% of the supply lost, just given the demands that are promoting that supply to come to market. Really a heavy penetration of electric vehicles. There's major supply and pricing impacts, which we'll talk about a little bit in this future slide. And then also we are looking at a situation where you have refinery rationalization and significant reconfiguration, not only from a crude to chemicals perspective, but also into a biofuels perspective. And then by the time we get to the 1.6 degree case, that is, in our estimation, is somewhat unreasonable from a petrochemical perspective. It requires a rethinking of chemical demand and a number of circularity innovations required. I mean, to go from 108 million barrels a day down to about 24 million barrels requires a huge amount of innovation when we look at that case. So again, very similar to the gas slide. We look at the 2.2 degree case and the 1.9 as the most realistic, and the range of outcomes in between is what will likely happen. So I want to talk a little bit more about feedstocks and the naphtha availability, especially as it relates to that 1.9 degree case. Here what we've done is we've done a simple relationship of crude runs to gasoline demand, and really when we look at gasoline and as a percentage of total oil demand, it is around 27% today. By the time we get into the 1.9 degree case, it declines to about 12% of demand. So it's a significant cut in terms of crude runs and what is dedicated to those crude runs to gasoline. And so really when we look at the gasoline demand and what is implied, it implies about 70 million barrels of crude runs when we look at 2033. And then by the time we get to the supply availability implied by the 1.9 degree case, we're actually looking at something more akin to, especially as it relates to naphtha, at around 6.7 million barrels a day. So that's really quite a significant change when we look at 11.2, given the relationship that we've been discussing here of crude runs to gasoline demand. So really, the 21.7 gasoline, 11.2, and then really when we look at the 6.7, that is a significant cut. So what we think is, there's a significant upside for crude to chemicals, and that is the end of my presentation. So I will pass it over to Steve so that he can talk more about ethylene.
Wrong device. All right, thanks, Carlo. I'm Steve Lemdeski. I lead the global olefin service, so we're covering ethylene, propylene, C4s, and some of the derivatives of propylene still fall under our olefin mix. Today I'm going to talk about olefins and polyolefins just because of some of the linkage and some of the trends are pretty consistent. And then some of the solutions maybe that we could see coming on the short run, and then a bit of a long-term horizon on what's going on. So, really on the ethylene space, the key message is we have four years of capacity overbuild, and this is going to have to be absorbed in some form or fashion. So it creates quite some challenges. In the next three slides I show, they're kind of a similar theme. In the top left, in the bars, you see capacity additions, year-on-year capacity additions. In the grayish line, that's demand growth year-on-year, and in the dark blue line, it's operating rates. And what you can see is really since the start of 2020, we've been installing a lot of capacity for ethylene around the world. I mean, we saw this coming really starting, I would say, in 2018 when China proved they can really bring assets on stream in a much shorter period of time than the rest of the globe. So we started shifting capacity adds up. We knew this was coming, but one of the key things that happened is, okay, COVID hit. Logistics had a lot of nightmares, and we had disconnections between different markets. Finally, really towards the end of last year and into this year, we see this overhang of capacity additions. In commodity chems, too much supply. You're going to have at the end of the day weaker margins, and that's really what we're envisioning. So the dark blue line, you can see operating rates dropping. This year and next year really are the low point in the cycle in our view, and then we see some demand recovery. I mean, there is one ray of hope. Maybe we start restocking in the chain a little bit more than all the destocking that took place, and maybe that will spike demand a little bit more. But really, we're thinking in the longer run, getting back to trend line, 6.5 to 7 million barrels a day. Tons a year of ethylene demand growth. To the right, everything's driven on costs. Carlos showed the base structure on energy and what we're thinking a bit on energy and supply demand with these cases coming up on transition. So you see the buildup, key markets, the key feedstocks on the bottom is U.S. on ethane. We see some lifting in the ethane prices because nat gas prices are moving up in North America. So a little bit of a rise in the cash cost there. Next in the queue is naphtha-based crackers in Europe, kind of ramping up as we see crude moving up in this environment and just more or less stabilizing. Northeast Asia naphtha, we see cash cost, spiking a bit and then coming off and really staying flat. And that's one key line to watch right now because I'm going to bring this up a little bit later when we talk about integrated margins into PE. And then last is China and MTO. That's kind of marginal supply on a global basis. And what we see is cost structure moving up as methanol prices get driven up, whether that's to traditional uses. There's a few more MTO units coming on stream. And then there's this pull into transportation fuel bunkers, displacing bunker fuel with methanol. So we see, cost ultimately moving with energy because 70 or 80% of the cost of ethylene is really in the feedstock. Prices, we see different price trends, all net rising. Again, oil's moving up. And the real story is on the right, and it's really about margins. In the U.S., we see margins ramping back up. The big reason for that is we think, we do have a cost advantage. We do think other regions will have to adjust more than they've been adjusting so far, and we'll start pushing contained ethylene into the global market. So we think we'll get some margin improvement because we get price lift and ethane stays relatively cheaper, and we're going to be a benefactor of that. Northeast Asia and MTO on the bottom, again, it's marginal supply. We don't see strong economics to operate those assets. And then Northeast Asia on naphtha, we're showing the dip. We see the oversupply. But when we look back in history and we see a bit of a tradition where when you are in a market that's oversupplied in the whole value chain, Normally where you have the most capital invested, which is in the cracker itself, you get a bigger piece of the pie in the longer run. And when we show PE margins, you'll see what that ultimately means. So we see a bit of lift in pricing on ethylene. All right. Now, propylene, again, it's a similar story, maybe even to a larger extent because we've really built way too much capacity. And a lot of this, you see the bars again. Bars are capacity adds. The gray line is demand growth, and you see operating rates. And really, a majority of the new propylene capacity was really based in China, based on PDH units. They really overbuilt on that space. They really needed on-purpose propylene. That's the best way to make on-purpose propylene, and they've added. So it's going to take some time to absorb that excess capacity, just like in ethylene. Again, on cash cost, we break this down a bit different. We're looking at PDHs in the key regions, so North America as well as China. A bulk of the PDHs, of course, are in China, 3 or 4 in North America, kind of on the fringe. And then looking at China MTO and China's coal to olefin CTO. So they're in the mix. Again, MTO is going to be probably the loser on a cost basis. Coal is going to drop in China, so we see a bit of advantage coming back to the coal-based assets. And it's probably even better for coal-based assets in China because a lot of CTO plants are integrated with a coal mine. And if you're next to a coal mine, it's really about the variable cost to recover the coal at mine mouth as opposed to the market price. So there's integrated operators in the CTO space that are looking at chain economics, similar probably to what the Middle East or Saudi does on oil. Their lifting cost is cheap. They can build crude oil to chems with a different perspective on what that raw material cost is. Propylene prices, a lot of volatility because of the logistics issues, shorts and longs in different parts of the world. But we see this market kind of re-equilibrating as, all the assets stabilize, logistics are back in a better place, and we don't see a lot of big arbitrage opportunities to move propylene around the world. And margins, again, we're giving margins back to the monomer as opposed to leaving it into the derivatives. So on polymers, again, same story. We've overbuilt. You build a cracker, you're going to build a derivative. 66% of the ethylene goes into PE. Normally, you're going to build a PE unit with it. So we've overbuilt both of them, quite frankly, together. And so in the top, you see similar graph again, but on the PE space, overbuild. It's going to take quite some time to reabsorb. And there's another wave coming. So there's a lot of new capacity announced, cracker and polymers in China. And why are they doing this in this oversupplied world? When you look at imports of net equivalents into China, even today, they're a net importer of some 15 to 20 million tons of contained ethylene. So even though they're building a lot and they have a lot in the queue, we still see them quite short. If their economy does recover, there's going to be quite an appetite for imports, and that's why Advantage Regions builds, so that we can move into that market. The line I wanted to reference now on this graph is the graph to the top right, which is the integrated margins for PE in China. So you look at the cost in China based on naphtha going all the way to PE. And you can see that's not really something to write home about. The margins are low for a long period of time because we just can't absorb all this excess capacity. So what did we do? We saw an ethylene price increase, but when you look at the integrated chain from feedstocks, naphtha to PE, it's really net zero. So we've shifted that margin. The pie has been split, and when we look back at other down cycles, this is exactly what played out. More of the margin, there's more pricing support for ethylene. Why is that? Because every plant isn't totally integrated into derivatives. There are merchant sellers of ethylene. They have a bit of a responsibility to make sure that the ethylene they price in the spot market is as high as possible, so for their corporation, they capture the most revenue. And we look at other derivatives pushing these prices out. We think there's room for them to support this price level and buy on a merchant basis some of this ethylene, and that pushes the price up. Now there is some non-integrated PE. If they're going to have to buy ethylene at those high levels, they're not going to survive, and they'll be the ones that will probably have to reduce rates to help kind of make adjustments. We're oversupplied, someone's going to have to reduce. On the bottom, again, similar story for polypropylene. We had our conference a couple weeks ago, and our colleague covering PP, it was doom and gloom, even to a larger extent than polyethylene. So a lot of challenges on the polypropylene front. Where does it go? Where does that market go? The one benefit they have is it's more regionalized. The Americas, Europe, kind of Russia and Africa, and then kind of an Asian market. So those markets are separated differently than ethylene, but we don't see big arbitrages at the end of the day when we look at these materials in the propylene space moving from region to region. It's just a quarter or 20% of what we see on ethylene. All right. So what can the market do, right? I mean, here we are oversupplied. We've added too much capacity. How do we shift from this down cycle to an up cycle? And to me, there's really 4 ways this can probably happen. One is we get a demand surge. What we really need is 3 years that we have twice the normal demand growth to absorb all that excess capacity. Highly unlikely, a lot of headwinds in the market. Can we get there? Most likely not. That's a big ask. There's a question about slowdowns of all these new builds coming in this next wave that we showed. Will FIDs all happen? Will they accelerate all those projects? To be determined, but like I said, for China, strategically they're short ethylene and contained ethylene. They have good reason to continue to build because they add assets at a much lower cost per ton of ethylene on an investment basis. It makes a lot of sense for them to do this. So will they slow down or not? I mean, there's a lot of headwinds in China, a lot of economic woes coming out in the news. So we'll have to see if to adapt, do they pull spending in that space. And foreign investment going into China's also slowed down. Maybe the rest of the world could defer and delay. I mean, the Middle East has a bunch of projects announced. Traditionally, they've taken longer to build than what China has demonstrated, so we'll have to see. Maybe I'll go to the bottom one, rationalizing assets. We just wonder if that's going to be the answer. It's quite difficult. Now, China does have a dual control policy. They have about 1 world scale cracker worth of ethylene that they're going to shut down. Probably on half of those footprints, they're going to level the existing site and rebuild with something much bigger. So, not a lot to be said for rationalizations there. North America has a feedstock advantage. We could look at South America. They have some, older assets running heavier feeds that are a bit challenged. I mean, we do look to Europe, right? When we look at leaders and laggards in the ethylene space and through the chain, there's challenges, and depending where energy goes, to be determined. But it's hard. Every site has its nuances. Are you integrated with a refinery? How many streams are going back and forth? It's just not as obvious to say, I'm going to shut it down because of a broader perimeter in the space. I think the one solution could be extended turnarounds. So normally when you're in the space, you do a turnaround, especially on crackers, somewhere between 30 and 45 days. That's about 5% normally of global capacity. What we could anticipate if you extend that not to 45 days, but maybe to 90 or maybe to 180 days, you can take a lot of capacity down. You can do that work in 5 days a week as opposed to 24/7, paying premium prices, et cetera. So I think there's a way that this can happen, and we're hearing in other parts of Northeast Asia where people are making adjustments along these lines. So I think one solution to this overhang is to do these turnarounds slower, probably at a lower cost structure, and then do all the work you normally want to do, because typically you have a turnaround, you got to rush, you hit a new critical path, and you're going to have challenges getting all the work done you want to get done. Now there's probably going to be room to get all that work done, anticipating hopefully the next upcycle. So what lies ahead? What's going to happen in the longer term? It's really about allocating resources and really an exceptionally challenging and aggressive agenda on environment, right? It's really something that we have to deal with. So what do we have on disruptors? Carlo mentioned energy transition, There's crude oil to chems. It's a matter of degree on how much oil can really go into petrochemicals. Do we have enough feedstocks? If you lose oil, you're going to lose NGLs. You even need more or something else, naphtha or crude, to make that happen. And what's going to be the ultimate price? Net zero. We're all talking about net zero. Scope 1 inside your own perimeter. Yes, you can manage that. Scope 2 and Scope 3 are more difficult. You're a buyer of electricity. In Scope 2, you're dependent on your supplier. In Scope 3, it's even more of a hodgepodge of suppliers on a lot of different things, cat, chem, you name it. It's going to be a big challenge. So, you're going to have to weigh in, how do we control this and a cost structure, and what ultimately is the policy going to be on that front. Circularity, will that destroy demand for prime resin and new ethylene, or will it go the other direction? Is it going to be mechanical, or is it going to be advanced recycle, and all the challenges that go with that? Still unclear where the world's going. Non-fossil fuel-based feeds, I think CO2 and green hydrogen is one being talked about. There's some assets coming in China on that front. Other technologies, so we're tracking some 13, 14, 15 different technologies, clever people trying to find different ways to get a better yield structure, less feedstock requirements, and less co-product production, as well as at a lower cost and lower CO2 footprint. So that's definitely out there. And it's really about demand shifts at the end of the day. What's the carbon footprint of synthetic materials versus natural? And who's going to win that battle? And maybe we're understating synthetic growth, because the footprint for fiber, for cotton, for steel, for glass, for cement is a bit higher than in what we can offer from a petrochemical perspective. So a lot of uncertainties out there, and this is a lot of what we're working on to work on scenarios. So with that, I'll hand it over to Duncan.
Okay, thank you very much, Steve. My name's Duncan Clark. I head up the aromatics services at CMA, and we kind of cover the basic fundamentals, BTX, all the way through the polyester chain, styrenics, polyurethane, feedstocks, nylon, and phenolics. Having listened to Steve, you're probably not surprised to hear that the European aromatics business has been going through a really tough time as well recently. And if you look at aromatics derivatives, they typically find their way into applications which are GDP driven. So things like transportation, consumer goods, packaging, appliances, construction. We started noticing a slowdown in Q3 of 2022. Demand got worse in Q4, and at least for the aromatics, it's really kind of not picked up since then. So I think we're all kind of aware how we got into this situation. There was the Russia-Ukraine conflict, created energy inflation and escalation on natural gas pricing. That was supported by food inflation as well, with less wheat, grain, oils coming out of Ukraine. Ultimately, central banks had to step in, raise interest rates. That increased mortgages and loans. And so we've seen a significant reduction in consumer spending and investments. And at this time, we're probably at a historical low of nameplate operating rates in Europe for the aromatics, which is obviously very problematic. Over the last couple of years, we've also seen quite significant capacity additions in mainland China, mainly serving their own domestic needs. But that's really put pressure on the global markets, and you've seen pricing come under pressure and margins turn negative. So not surprising, in Europe, we're also seeing negative margins. So at the moment, we're kind of facing the worst of both situations, very low demand and negative margins, and that's obviously unsustainable. We've seen widespread closures of assets across Europe, some obviously mothballed temporarily, but others closed permanently, including the relatively new TDI plant in Ludwigshafen. So I think the question really for the conference and also the future of the industry is, when will the recovery start, and will sustainability form part of that recovery? So if we look at the economic forecasts, our colleagues at Oxford Economics essentially predict that relatively slow growth in Eurozone this year of just 0.5%, with Germany in recession, and only about 0.9% growth for next year. Then that moves up to 1.8% 2025, and then slightly above 2% in 2026. So the recovery from an economic perspective will be quite slow. Also, some of the export markets will be struggling. You know, we're looking at a recession for the first couple of quarters in the US for next year, leading to just minor positive growth of 0.2%. So US now starting to feel the real effects of high inflation rates. And that really won't be necessarily a great outlet for Europe. Also, China is predicted to slow in terms of its economic growth. So we've got 5.1% anticipated this year, declining to 4.6 next year, and then kind of moving along at that level. So ultimately, natural gas pricing has come down, certainly compared to the summer, but you know, we're now reliant on natural gas imports heavily from the United States. As Carlo has mentioned, that's going to be carrying additional liquefaction and transportation costs. Supply of natural gas from Russia, in our view, will never be restored to the levels that it was in the past. So we'll be relying on imports for a long period of time, and that additional cost will exacerbate the cost differential between the US, Middle East, and European regions. And therefore, there'll be more pressure from imports on the aromatics from those areas as well. So from a demand perspective, if we look at the 2018 market, we've gone through COVID, we've gone through this energy crisis, we're now at a low point. We anticipate that these markets will recover, but it's going to take quite a period of time from a demand perspective. And on top of that, we'll see more pressure from imports as well, additional imports. So I think it's right that there will be some rationalization in the industry, and obviously some of that has already been announced. In terms of sustainability, still very strong interest, at least in the consumer products area, for some component of sustainability. So, you know, that can create short-term differentiation opportunities. But on a longer-term basis, that really just becomes part of being in the business. So sustainability will develop at a relatively slow pace. But we're also seeing at the same time a reduction in gasoline demand, and Europe will also see reduced exports of gasoline next year if the Dangote refinery in Nigeria comes online. Longer term, we're anticipating refinery closures. So does that point towards potentially, you know, some gasoline reformers being able to convert to aromatics with extraction units? If you look at the West European market at the moment, we've got around 1 million tons of import demand for benzene. And although over the next couple of years that will be softening a bit, we anticipate as more reformers close that benzene import requirement will grow again. So longer term, there will be that demand for additional benzene. The issue really is around placing the methxylenes and the toluenes. So that can either go into, you know, relatively weak paraxylene, orthoxylene markets, or into the gasoline pool. And I think from a short-term perspective, we anticipate that the gas naphtha spreads, which, you know, have really ballooned out in 2022, $600 a ton, this year have come down about $300, $400. Especially in the US, we're anticipating the gas naphtha spread to be close to $300 for the next several years. So that's going to be a big incentive, and particularly with, you know, some potential rationalization on the cracker side and negative margins, weak naphtha market. Especially in the US, there will be an incentive to buy the naphtha blend with high octane materials. So there should be some availability for methxylenes and toluene into the gasoline pool. And in fact, you know, from a global perspective, it's really gasoline which has been saving the aromatics markets recently. A lot of interest in new kind of blend components like ethyl benzene. Styrene market has been very depressed, but ethyl benzene sales have gone up to around 1 million tons, representing now 1% of the benzene market, benzene derivative market. So also cumene, you know, historically not gone into gasoline on a regular basis, is seeing significant volume. So those who are involved slightly further down the chain, who have the ability to manage the logistics, can rely on some support from the gasoline markets in Europe and the US in the coming years. From a longer-term perspective, though, as we start to see the energy transition, the gas naphtha crack spreads are going to reverse. So we'll see positive naphtha crack spreads, negative gasoline crack spreads, which obviously means that the costs of mixed xylenes toluene from a naphtha perspective will be going up, but the differential to pay the mixed xylenes into the gasoline pool will be expanding. So we'll see higher than historical rates prices for toluene relative to gasoline as we get out to 2028, 2030. Okay, on that note, I'm going to hand over to my colleague Hazel.
Thanks, Duncan. I am Hazel Cruz. I lead the inorganics team at Chemical Market Analytics, and within inorganics are chlor-alkali and vinyls, so I'll be talking with you this afternoon about our expectations for the chlor-alkali and vinyls markets, and we will start with chlor-alkali. I'm going to draw your attention first to the chart that's in the upper left-hand corner of this slide, where we've compared the capacity and operating rate forecast from a year ago from our 2023 supply-demand balances to our updated forecast from our newly completed 2024 supply-demand balances. And you can see from this chart the effect that economic conditions deteriorating over the past 12 months have had as we slide into a downturn in the chlor-alkali market, which I'm going to refer to here as a mini trough. So why do I call it a mini trough? A trough is a trough, right? Well, I want to distinguish this clearly from the significant trough that the chlor-alkali market went through between the years 2008 and 2016. This is a very different situation, and I also want to clarify that this is different than the downturns that some of my colleagues here are talking about in other base chemical markets. Unlike the situation that Steve talked about, this is not a supply side trough. This is a demand side trough, clearly. If we talk about this mini trough, the changes in geopolitical conditions, economic conditions, energy conditions over the past year have eroded chlor-alkali demand pretty much in all world regions. And that's the factor that causes the operating rate decreases over the next several years until we climb out of this trough. There are some capacity items which I will talk about in a minute, but this is really a demand-led trough. To look a little bit more deeply about that, two particular factors in the demand-led trough. The first one is Europe here, where we have seen legitimate demand destruction. We have plants running in the low 60% range, really at minimum stable operating rates, moving some offshore to keep those plants stable because we've just experienced demand destruction. The other area that is notable with respect to erosion of demand is China. I'll talk about China several times in these slides, but basically China has not come back post-COVID at the kind of chlor-alkali demand and demand growth that we saw pre-COVID, and that is affecting this turn down in demand and a bit of a trough here. So I want to reiterate, this is not a capacity-driven trough, but at the same time, I want to draw your attention to the chart on the upper right side of this slide, capacity addition, where I'm showing the capacity additions over the past 5 years by region and those projected in this mini trough period. That bold blue color is Northeast Asia. And when you talk about chlor-alkali and capacity addition, Northeast Asia is essentially China. What I want to really focus on here is the shift in where the center of new capacity is happening that occurs around 2025. Those projects that we're foreseeing over this trough period, those were in progress before the economic conditions started to weaken. They will complete, they will come on stream, but as we get to 2025, we see a decrease in new capacity. And now I want to compare this to what happened in what I'll call the dark ages of chlor-alkali, the deep trough between 2008 and 16, to characterize how much does this new capacity really matter. Between 2008 and 2016, the average annual capacity growth rate in China was about 9%, and the average annual global capacity growth rate was about 5%. Really significant capacity growth. That was a capacity-driven trough. If you take all of these new capacity projects between now and 2027, that equates to an average annual capacity growth of about 1%. So slow demand over the next couple of years and then climbing out of that, we think that the market is very capable of growing into this new capacity over this 5-year period. So I'll draw your attention now down to the bottom right chart on this slide to talk a little bit about a bright spot in demand in the chlor-alkali market, and that is caustic soda for the EV market. Electrification of the mobility market is creating a lot of changes. It's changing the energy market, it's changing things culturally, it's changing some chemical markets, and chlor-alkali is one of those markets, particularly caustic soda. The metals that need to be mined and refined for EVs, some of them require caustic soda. Cathode production requires caustic soda. Battery recycling requires caustic soda. So along with the increase in electric vehicle production, so are we getting an increase in caustic demand. And in fact, applications for EV production is now, and we expect it to continue to be, the fastest growing demand sector for caustic soda. Okay, last I want to bring your eyes over to the chart on the bottom left of this slide, a little bit about caustic soda and chlorine contributions over the next 5 years. If you follow the caustic soda market, then you likely have seen that domestic caustic soda prices in China have bumped up recently, and that's pulling spot caustic soda prices up in Northeast Asia. If you're a caustic soda producer, don't get too excited about that. If you're a buyer, you don't worry too much about that. We think that's a bit of a flash in the pan because of some things that are happening short term in China. Overall, our expectation is this demand slowdown in chlor-alkali will in fact weigh on caustic soda prices in the near term until we see some turn in the market and demand recovery toward the end of 2024. So with that, let's jump over to vinyls. And I'm going to start again by drawing your attention to the chart in the upper left-hand corner of this slide, where once again, we're comparing what our forecast was a year ago, our 2023 balance and forecast for capacity and operating rate against our updated 2024 supply-demand balances and where we think capacity and operating rate are going. And it's not surprising that you see a pattern not dissimilar to chlor-alkali. If I was to do a word association game with the words PVC, with the letters PVC, the first two words that would come to mind would be interest rates and China. We are going into a downturn in PVC. There are some PVC applications that are not associated with construction, but PVC, to a very great degree, is driven by construction. We've all seen that interest rates have risen considerably over the past year around the world as central banks have tried to get their arms around high inflation. PVC demand reacts to interest rates very quickly and inversely. So as construction markets have slowed with higher interest rates, so has PVC demand slowed, and we see that effect in the operating rate decrease forecast for 2023 and 2024 against what we projected last year. The other piece of this I mentioned was China. I'm going to ask you to look at the chart or the table on the upper right-hand side of this slide, where I've broken the first 3 decades out in 3 chunks for China, looking at the average annual GDP growth rate by decade and the PVC demand elasticity by decade. This table is really a picture of a market that's maturing. If you look at the forecast for the period 2020 through 2032, compared to the 2 prior decades, you see that the PVC market has effectively matured in China, and China is the world's largest PVC market. It's the market that's been driving PVC demand. Instead, that's moving, high growth is moving to India and Southeast Asia. If we look at the capacity additions in the bottom left chart, we see that those two are moving toward India and also the Middle East as this 5-year period progresses. That's because the new high growth areas are India and Southeast Asia, to be fed by imports and by new capacity on the Indian subcontinent. What does that mean with respect to cost and margin outlooks? Well, Steve shared with us that ethylene prices are forecast to be climbing across the 5-year period. That is going to put pressure on margins. In the meantime, we expect the decline in PVC prices from the astronomical highs of 2022 to be in a trough period in 23 and at least the first half of 24, and then rise out of that position with margins increasing. So that is my very quick trip through chlor-alkali and vinyls. I would invite everyone here to join me and my colleagues here in the stateroom on the first floor of the Palais Coburg, right across the park. We'd be happy to entertain questions that you have about any of these markets and to discuss them further. Thank you very much.
Thank you, my full team. Please join me in saying thank you. And we will not be taking questions in the interest of time, but my colleagues will be here to answer questions, and as Hazel mentioned, we will be in the Palais Coburg, and we'd welcome your visit and dialogue with you. Thank you again. Bye-bye.